we have you diversify. For example, just exactly it's similar to natural hedging, but natural hedging is more of now taking into account the long position and short position across different or multiple currencies to hedge yourself against the forex risk. Now, diversification is basically where you can not only diversify across the currencies, the major world currencies, but you can also even across different industries and across even different types of currencies. For example, you can even diversify on even commodity backed currencies such as the CAD or the UAD. You don't just, AUD. Yeah. The Australian dollar and the Canadian dollar are the commodity backed currencies. You don't just focus on the major currencies, or you don't just invest on the major currencies that are known to have high volatility or high forex risk, that for example the euro and the USD, they are known to be. So you diversify even into other currency pairs. You can even diversify into, for example, you hold also a little bit of Canadian dollars, Australian dollars, a little bit of Malawian kwacha here and there. Yani you just diversify here and there, and then at the end of it all, you will have hedged yourself, because it's very, very unlikely that all these market will crashes or all these currencies that you have invested in will weaken, and therefore you will face forex risk. So to conclude, we know that banks face forex risk, but it's the responsibility of now the Treasury departments in such banks to put in place measures to be able to measure such forex risk and the various types of forex risk like that. For example, the transaction risk, translation risk, and also economic risk. For example, you can calculate in terms of the portfolio at VAR. We talked about how you can calculate the portfolio at VAR. For example, you take the long position that you hold times the Z-score, confidence level, plus the historical volatility. And therefore, that historical volatility part is where now disclosures, monthly disclosure, quarterly, and periodic disclosures comes in. And that's where the Treasury Department is very, very critical to be able to monitor at intervals and to be able to report and monitor the currency fluctuations and the forex risk that their banks face. And then so now when they calculate, then once they calculate, they identify, calculate, and then so now they can put in appropriate treasury management and risk management, or rather specifically forex risk management strategies and frameworks to be able to hedge their banks against such currency fluctuations and risk. We have talked about the three forms of hedging, that is currency